All right. So, when we talk about diversification, you have to understand that um, you don't want to have all your eggs in the same basket ever. The reason being that no matter how good your analysis is, no matter how good a company is, shit can still happen. Something can still go wrong, no matter how good it is. Something can still go wrong. It could be that government introduces one crazy policy. It could be something can still happen. So you don't want to put all your eggs in one basket. So I usually advise, and that is something I learned from one of my mentors, you want to have a portfolio of at least 10 different companies. You want to have a portfolio of about 10 different companies. If what you have to invest is $100, find a way to split that $100 across 10 different companies. And I'll talk about the kind of companies or kind of companies you want to, let me just put it that way, broad categorization of companies you want to put your money into. Now, we have what we call growth companies. For those of you who bothered to read through the stocks part on the website, you have growth companies, you have cyclical companies, and you have defensive companies. There are more categorizations, but these three are very broad categories that other categorizations fall under. So you have growth companies. Now, these growth companies, they don't usually pay a whole lot of dividends, but their share prices are expected to grow crazily. So it makes up for them not paying a whole lot of dividends. Now, cyclical companies, a whole lot of cyclical companies are companies that rotate with the economy, things like banks. So when the economy is not doing so well, they get affected, bad loans and all those things. Companies that also need a lot of loans from the banks. So when the economy is not doing so well, things like construction, when the economy is not doing so well, they get affected. All right. So those are cyclical companies. And then you have defensive companies. Defensive companies, they don't grow a lot, but they really fall a lot. They are, for those of us who did economics in school, their products have what we call inelastic demand. Those are the companies whose products have very, very inelastic demand. So whether you like, if you are, except you are dying, you are going to use them, right? So things like Procter and Gamble, the creators of uh, diapers, detergents, and all what have you. You don't have an option. You are going to wash your clothes. So you're going to need detergents, right? If you have a baby, you're going to need diapers, right? So these are things where you don't really have much of an option. You are going to use them. Just like Pepsi. The economy is good, the economy is not bad, is bad. If people throw parties, they need to buy Pepsi. People go to stores, thirsty, buy Pepsi, they buy Coca-Cola, right? So these companies, regardless of what is going on with the economy, people will still be using them. Another example are healthcare uh, companies, healthcare stocks. So you are you don't have money, but you fall sick, you will spend the money that you have or don't have to treat yourself, right? So whether the economy is good or the economy is bad, defensive companies are going to remain, are still going to be doing well, they're still going to be making their money. So what happens is when the economy is doing so well, growth companies, they fly to the moon. They fly to the moon. Cyclical companies begin to pick up. But when the economy is stagnating or not doing so well, growth companies tend to fall a lot as well. They tend to fall a lot as well. However, defensive companies, when the uh, economy is not doing so well, they will fall, but they will not fall by much. Now, the what's it called? When the economy is doing well, they will rise, but they also not rise by much. So whenever you are building your portfolio, you want to have a good mix between the growth companies, the cyclical companies, and the defensive companies. Why? The growth companies are going to make you the most of your gains. The defensive companies are going to protect you when there is a crash. And then the cyclicals are there to just kind of maintain. Usually you want to buy cyclicals when there is a very, very deep crash. So usually you want to get in on cyclicals when their stocks are falling. Good companies, remember these are good companies, great companies. You want to get in on cyclical companies when their stocks are falling by more than 35%, right? So those are the things you want to be looking at. Now, what will determine the portion of each of these companies that you have is your risk profile. Now, someone that is 30 or 35 will not or should not be investing the same way as someone who is 60. Someone who is 60 has to protect himself. He can't take so much risk. Someone that is younger can afford to take more risk. So usually, the younger you are, the more skewed your portfolio should be towards growth companies. The older you are, the more your portfolio should be skewed towards defensive companies. Because those defensive companies, they are the ones that pay a whole lot of dividends, right? So at least in your old age, those companies are going to be paying you the dividend that you need to get income to sustain your daily life, right? But at the onset, your portfolio should be skewed towards your growth uh, companies or growth stocks. Now, if you have, let's say you have about 10 stocks in your portfolio, right? Now, if you are young, you are relatively below 40. Usually, your growth companies should take at least 50% of that. So I call it um, a high risk. It's high. I call it high risk, but it's not really high risk like that. But in terms of what can happen, the kind of drop you can have, or you call it a high growth portfolio. So you should be having about 5 of them, 50% of your portfolio should be allocated towards growth companies. Your growth companies are usually your, for instance, now I'm going to be concentrating, sorry, we'll still come back. If you bring a stock from outside the US, we'll still go analyze it. But now I'm going to be concentrating on US companies because that is where I do the bulk of my, that's where I do all the investing I do when it comes to stocks. Now, when you go to the US stock markets, what you have on the US stock markets when it comes to growth are usually, let me open my portfolio. So you see from Microsoft, Apple, Nvidia. So your tech companies, your communication companies make up your growth companies. So your tech and the communication make up your growth. And then to some extent, a bit of consumer discretionary, but a few companies, just not every company consumer discretionary. So I would like to just keep it to your tech companies and your communication companies, which are, for instance, Google is not under tech. Google is under communication. Meta as well is under communication. So when you come to your tech, you have I would like to Google that because of our time. You have hardware, people that produce hardwares such as Apple. Apple produce devices. You have software people. You have operating systems such as Microsoft. Then you have software guys such as CRM, Oracle, Adobe, and all the rest. Then you have semiconductor companies such as your NVIDIA, the largest foundry in the world, TSM, and ASML as well, under those ones. So those are basically your growth companies. Now, when you talk about discretionary are those guys that they really flow with what is going on in the economy per time. So the more people have money to spend, the more they're going to spend it. So you have things like your Amazon is a bit away from this because Amazon is a cross between e-commerce and tech, right? So Amazon has a whole lot of e-commerce. That was their bulk of their business but they've been going into cloud. They have a cloud is becoming a huge part of their business as well. So they have the properties of both um, tech companies and discretionary companies. So your cyclicals, you are looking at your banking stocks, you are looking at industrials, you are looking at material companies, such as, for instance, in Nigeria, a good example is your Dangote. Dangote is materials, it's two materials. So all those things that you use to produce other things under materials. So, and then finally, your defensive companies are those in US, we are talking about your consumer defensive. That is what they are called, consumer defensive or consumer staples. So you have things like your um, Pepsi, your P&G, Procter and Gamble, and then you also have health stocks. So you see all these guys from Costco, which is a wholesale um, outlets, Amazon, Walmart, Visa, MasterCard. So your finance banking as well is under cyclicals. JP Morgan as well. That is the only bank that I really have on my own watch list. Then your healthcare too is under consumer defensive. Things like your United Health. This is basically one that provides what's it called? Insurance, provides consultancy services to almost a whole lot of the hospitals and healthcare providers in the US. Then you have a Lilly, which is one of the biggest health companies in the US that manufactures drugs and all that what have you. And then Johnson and Johnson, which is a popular one, that's almost all of us should know about. Johnson and Johnson, manufacturers of so many healthcare products. Then you have your normal consumer staples such as Pepsi, Procter and Gamble. Coca-Cola is here, but I'm not really willing to put money in both Pepsi and Coca-Cola, knowing that they are both defensive companies. And Pepsi, in my considered view, is a better business than Coca-Cola. I drink more Coca-Cola than I drink Pepsi, but Pepsi is a better business. As you will see, if we have time, I'll also do a brief analysis of the banks in Nigeria. You see that while I have an account with GTB, a company like Zenith is a better business to actually invest in. So it's the fact that you're using something does not necessarily mean you should invest in that particular thing, what have you. All right, so let's now look at technical analysis and then we'll dive into the charts. So the proper way to do your technical analysis, you want to look at the whole market, right? So you want to look at, for instance, if you're looking at the US market, you want to look at the S&P. I would advise you stay away from penny companies. Stay away. Stay away from them. Invest in notable brands. Invest in big companies that cannot be easily disrupted. That is how to make sure it looks like, yeah, they've gone up so much. You wait when they come down. They will last longer than all these penny companies. A whole lot of people, I remember when I was growing up and just about to enter into the university then, and all these penny stocks were making waves then, making a whole lot of waves. Penny stocks, penny stocks, penny stocks, penny stocks, penny stocks, until the whole thing just came crashing down. All right. So you want to just avoid all those things. The smaller the company are, the more difficult they are going to is going to be for them to survive all the things that happen in the marketplace. And a lot happens in the marketplace. So once you look at the whole market, you want to invest in the market that is showing a trend of growth. All of us here are traders, or I want to believe most of us here are traders. So you want to look at uh, the market and see a situation where, let's look at this, you are having consistently, or let's even look at this chart, higher highs and higher lows. So makes a high, just a moment. Makes a high, pulls back, the higher high, pulls back. Still, this is still part of this whole move. Up, pulls back, higher high, up. That's what you want to be seeing. If we go look at SPX, that will concentrate on the stocks that we came here for. on your load. All right, so this is what you want to be seeing. A consistent history of higher highs, pulls back, up. This was COVID, which was really crazy. So, but still remained generally on an uptrend. All right, pulls back, break higher, pulls back. And then we can continue going back. You'll continue to see that a general trend of higher highs, higher highs, higher highs, higher highs, higher highs. Right? That is what you want to be seeing happen in the market. Now, once you've analyzed the whole market, you can actually decide to analyze the sector. That one is not compulsory, right? You can choose to look at the sector before coming down to the stock trend. But because of our, please, we can let's drop companies that you want me to look at. You can drop those companies in the chat, companies that want to look at, so that we can start doing that right now. Then you want to do your stock trend analysis. You want to also have a situation where it's generally going, creating higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. All right. Now, I'm going to drop a secret sauce which will transform so much things or so many things that you're doing when it comes to investing. And that is this. This is a tool that is available on almost every charting platform, but I would like you to use it on TradingView because their data on TradingView is usually better than what you find elsewhere. And it's simply, drum rolls, your envelope. So those of you who have been trading, who are trading the swing shots, you already know of this tool, but what you probably don't know is the settings that I'm using. So when it comes to long-term charts, the popular moving average, I'm not going to go into the history of how envelope works and all that. We use is the 200 moving average. That is what we use to check whether it is in a long-term uptrend or a long-term downtrend. And then people also use it as a way of knowing how far away price has traveled. Let me stop that because of our time. So the settings 200, length 200%, one, and then you want to use the source as close. You can have this on or you could have it off. Whichever one you're using, be consistent with it. Sometimes it will give you a better entry, sometimes it will give you a worse entry. Whichever one you're using, just remain consistent with it. So length 200% here, 1%. Good. So we have this as it is. So now, whenever you want to get in on a particular asset class, you'll be waiting for two things to happen. You are waiting for two things to happen. You want the entire market. So if it is in the US market, for instance, you want the gauge that measures the entire market to fall by at least 20%. You are waiting for this gauge that measures the entire market to fall by 20%. There are other ways of doing this, but I'm not going to discuss it here because I'm not going to be discussing the entry trigger that we use in the SME course. But they're going to look at how to dollar cost average from these key levels. Now, once you see this fall by at least 20% and hit your envelope, then and only then do you begin to look for entries on your bets. All right, so let's quickly look at some examples. So we are just going to look at the last, let us look at the last 10 years. Let's look at the last 10 years. So that will start from 2016. Just because of our time, we could go further than that. So you just measure this from the top. Nope, didn't meet our criteria. For those of you who are going to be in the SME course, we'll see how to play things like that. We'll actually still enter on this. but there are other ways to do it. Just don't want to go into that. Yeah. All right, so measure from here to here, and this gives us our 20%, virtually on the dot. And that is when we'll start looking for entries. When was that? That happened 24th of December, 2018. So I want someone, or in fact, every one of you could do that. Note when we get that. This is happening 24th of December, 2018. We are going to come back to look at those dates. All right. Then we'll look at this. This was the COVID crash. When did it drop into here? 20%. Yeah, and touched it. This happened 9th March. 9th March 2020. That is when we begin to look for entries. And then we had the 2022 bear market as well. All right, so right here, the 13th of June, 2022. So we have 3 dates we are going to work with to look at the various stocks that people have mentioned. I think 40. Okay, we have about 15 minutes. All right, Apple, Bank of America, Netflix, Tesla, Nvidia, okay. So let's start with Apple. We'll do as much as we can. So first thing is Apple. You need to understand what Apple is. Apple is a growth company, right? Apple is a growth company. So that's the first thing you need to understand about Apple, right? So let's see. Now, when you open your individual stock, you also want the same thing to happen. So you want it to drop by 20% and to drop to your level. So we'll see 2022, this didn't drop into this. So we'll have let it go. 2020 didn't drop into it. But we'll see 2018, it dropped into it nicely. Right? Let's measure. Uh-oh. From the top. Nice. Good. Now, before we begin to salivate over Apple, let's make sure Apple is a great business. So you just come here. All right, come to this top here. Click on this more. And you want to go to financials. So when you click on financials, we start with overview so that we'll look at some of the key things we want to know. So the first thing you want to check is the ownership. You usually want to invest in companies that the majority of the shares are free float shares, meaning the company is largely floating its shares on the stock exchange. Any person can buy it. You don't want it to be largely in closely held shares, meaning a few people have the whole, a few people are controlling the company. That is basically what that means. You don't want that. The reason is you don't want a situation where one person's decision or indecision can have outweighed or outsized impact on the company. All right. So once you've seen that, for me, you can move on to statements. All right. Now, statements, you want to go to your income statements. We'll start from there. And you want to come to annual. Remember, I said we want to see 5 to 7 years of data telling you about the listing of the company. So if you look at this, you can see that generally revenue, you can see this blue is the revenue is growing. It's largely growing. Okay, last year it dropped a little, but overall it has been on a growing basis. All right. If you also look at the gross profit, you see the gross profits increasing generally, right? You also see the same thing for the net income, right? So it's a good business. Let's come to the balance sheet. So when it comes to balance sheet, there are so many other things we can look at, but we'll look at it elsewhere. So we'll go to statistics. And again, you want this to look at this on an annual distance. So scroll down. These valuations, profitability ratios, we use all those things in the SME course itself, but just forget about it for now. Now, when it comes to these liquidity ratios, this tells you how solvent a company really is. Now, the thing you want to really pay attention to here is the current ratio. And if you click here, you will see a, what's it called? A meaning of each of these things if you don't know what it is. So your current ratio is the total current assets divided by the total current liabilities. So it tells you the assets versus the liability. How is it? Usually I want this to be 1 or higher. Usually I want this to be 1 or higher, right? Now, 0.99, 0.95 can still be managed. Then debt to equity ratio. The debt to equity ratio, I want this to usually be less than 2. All right, usually be less than 2. So generally, yes, less than 2. It's manageable and a good business. And then on other distance, that's we are going to have a part 3. Okay. On other things you want to look at, they are doing reasonably well. So if you want, you can check how this goes into your various distance. Now, you want to look at the earning per share, right? What are you looking for in the earning per share? The first thing you want to see is you want to see that the earning per share is growing. This is what tells you that they're actually making the earning per share is what you as a shareholder will earn if they were to distribute their profits to all the shareholders. So you want to see that this number is actually growing. You want to see it that it is growing. And then you want to see the projection that the projection is also projected to grow. Now, when you're also looking at the projection, you want to check and see how they've compared to previous projections. So you want to see that they are either meeting the projections or exceeding it. So here they exceeded the projections. Here again, they exceeded it, exceeded, right? So they've been good in either just maintaining to exceeding it. So that tells you that this projection or forecast that you have here is actually going to also be what? Reliable. And what do you see? It's still projected to grow over the next coming years. This 2024, 2025, 2026, 2027, you are still seeing growth, right? So we'll do more if you attend the semi course because of our time I'm having to rush. So, but let's go back to the chart. So a decent business from the financials. Now let's look at, I didn't look at one very, very important metric. I didn't look at one very important metric. Let's go back. And that is the free cash flow. Annual. All right. Another thing I really like to see growing, at least if it's not every year, at least more than 75% of the period I'm looking at is the cash from operating activities. I want to see that growing. Now, but the free cash flow is really very important. You want to have a situation where the free cash flow is showing strong signs of growth, right? So showing strong signs of growth. Um, if you see a negative, you want to go and find out why they had a negative, because sometimes the reason why you have a deficit in free cash flow is that the company decided to maybe acquire more companies. All right, just like what happened to it, I think it was in 2019, they decided to do a whole lot of acquisitions to spread their branches all over the world and all that. So that was what affected them here. So, but overall, you can see even when they had this was just minus 3.6, and then it's covered by plus 25%, minus 8 covered by plus 24%, plus 26%, plus 19%, and all that. So, because that free cash flow is the money that is available to pay to shareholders if they wish to, or to plow it back into the business. So what you're going to do if you have this. Now, whenever I am buying companies, I don't like to buy, you don't want to buy in one go, except in special cases. So you want to divide money. So let's say you have $10, just using that as an illustration, to put into or $9 for ease of calculation. You have $9 to put into a particular business. You don't want to just put everything into at one go. You want to put it in levels. And the way I do this is 20%, that's my level one, 35% is level two, and 50% is level three. All right. So if it falls, it crashes by 20%, and it has fallen into my envelope, right? Then I can buy the first level. It falls to by 35%, you can buy the second one. And then if it drops by 50%, which happens like once in 10 years or once even in 15 years, then you can buy the last one, right? So, however, some cases, the 20% will occur above this level. It will occur somewhere here, just like this one. If we take our measuring tool, the 20% occurs somewhere here, which hasn't dropped to where we want it to be. We're not going to buy. We'll add up that money and wait till it drops into the zone. Right. Now, when it drops into the zone, for those of you who are coming to the SME course, you discover that another thing we are going to be looking at is the intrinsic value. Usually, by this time, it is way below its intrinsic value, but occasionally you still want to check, which was something that happened with a company like Tesla recently, where it dropped but was still not below its intrinsic value. So you want it to be below the intrinsic value. But with this, don't worry. If you're not, you can still use this by itself. So 20%, it wasn't there. So we'll be waiting for the 35% level. And 35%, let me expand it. All right, so it falls by 35%. Let's see. 35%, it really wasn't at it, but let's just assume that that was 35%. So what we have done is that the $3 we should have put in here from the 20%, we'll add it to the second $3 we should have put at 35%. So we'll now buy $6 worth of Apple at this level, and then keep the remaining third one if it falls to 50%. This one didn't fall to 50%. This didn't fall to 50%. 50% would have been about $29, right? It didn't fall there. So, but we got at a 5%, right about $37. So if in this occurred basically, let's even use this. The thing we were looking at was 24th of December 2018, right? So this is 24th. So let's assume we buy at the close of that, or you just put your level, 35%. I want to get in here. All right. So you buy at that level, 37.60, right? 37.60, 2018. The price of Apple right now is 220. 2018 to now is about 6 years. So let's do the maths. Now remember, Apple has fallen by I think about 7% so far this from its top this year, but let's forget about that. So 220 divided by 37.6, and that is 6.1. So your $6 in Apple by now has turned to at least $36. So that is the power of investing. So let me quickly take note of the one that someone has mentioned. Okay, we'll look at Bank of America, BSC, and I think I'll just take two more. Our time is almost running out, so I'll look at Netflix, and I'll take. I think I'll just take those two for now. If we have more time, because I also need to mention how you can partake, how you can begin to invest using and so once this so this just what you did before, just rejoin again, and then this will be the last one that we will have. I will make sure that we are done.